Most people do not have a money problem. They have a machine problem. They attach their life to a machine that pays them fast, taxes them hard, keeps them tired, and convinces them that motion is progress. Then they look up 10 years later and wonder why the scoreboard barely moved. I have watched that mistake ruin smart people. They save, they work, they stay busy, they chase promotions, they read about investing, they clip coupons on one side of life while hemorrhaging wealth on the other. They think the game is about effort. It is not. The game is about building a machine that turns effort into ownership, ownership into control, and control into freedom. If your machine only produces income, you stay useful. If your machine produces equity, you become difficult to control. That is the dividing line. I want you to see this clearly, because the modern money world is full of polite lies. It tells you that if you work hard, diversify widely, avoid all debt, and stay patient, wealth will eventually arrive like a pension check in the mail. That is a bedtime story for adults. Money moves through systems. Wealth comes from design, and if you do not understand the design, you will spend your strongest years feeding someone else's machine while calling it security. I have spent my life allocating capital. That means I have spent my life studying the difference between people who look rich, people who earn a lot, people who get a temporary windfall, and people who quietly build a machine that keeps getting stronger while they sleep. Those are four very different creatures. Most people never notice the difference because they are hypnotized by speed. The first trap in the machine is this: money loves speed, but wealth loves time. That sentence is simple enough for a child to understand, which is exactly why adults miss it. You can make money quickly. In fact, a great many energetic people do exactly that. They find an opportunity, move fast, turn in. They feel clever because cash moves. Their friends call them hungry. Their family says they are winning. But speed creates noise, and noise often impersonates progress. I have seen men flip one deal after another and stay financially fragile. I have seen other men hold one sound asset for a decade and quietly become impossible to intimidate. The reason is not mysterious. Fast money rewards reaction. Real wealth rewards endurance. If you buy something sound and hold it long enough, time does work no human being can imitate. Time lowers your error rate. Time compounds your right decisions. Time lets taxes defer. Time lets business quality emerge. Time lets reputation, scale, customer habits, and pricing power do their slow, boring work. Time is not decoration. Time is the main motor. A man who acts fast on a good opportunity has an advantage. A man who acts fast and then holds still when the asset is right has a different class of advantage. That second man usually wins. You see this in real estate, in businesses, in stocks, in relationships, in habits, and in reputation. A person can spend 5 years buying, selling, rehabbing, trading, switching, churning, and bragging. Another person can spend those same 5 years buying one sensible thing, improving it, refinancing it carefully, adding to it, and refusing to interrupt compounding. At the end of the period, the first person has stories. The second person has net worth. Do not confuse fast action with fast results. That confusion has made brokers richer than investors for generations. I like speed at the front end and patience at the back end. When the pitch is right, I want the shortest possible distance between recognition and action. But once I own a good business, I do not need daily entertainment. I need the machine to keep operating. You do not dig up a seed every morning to check whether it is growing. Only insecure people do that. The mature investor understands that silence is often a sign that the machine is working. That leads to the second trap, and it is far more brutal than most people realize. The person who gives the money usually controls the outcome. You can work inside a company for 20 years and still be renting your life. You can build something, sell it, celebrate, and still discover later that the buyer made 10 times what you made. You can create value and still leave the table before value matures. This is why so many people spend their life near wealth without ever touching its nerve center. They are operators without ownership. They are builders without control. They are earners without terms. The control premium is one of the most misunderstood forces in capitalism. Everyone likes to talk about hustle. Very few like to talk about who sets the rules, who signs the checks, who owns the asset, who controls the capital stack, who can wait, and who can dictate terms when pressure rises. That is where the power lives. Buyers and owners have structural advantages that workers and sellers rarely understand until it is too late. If there are no buyers, there is no market. If there are no capital allocators, many businesses do not expand. If there are no people willing to write checks, many founders remain talented prisoners of their own payroll. I want you to notice something ugly. A salary can make you comfortable. It almost never makes you sovereign. Salaries are good at funding your current life. They are not very good at transferring control. They are linear. They arrive, they get taxed, they get spent, and they disappear. That is not a wealth machine. That is a cash conveyor belt. The conveyor belt feels safe because it is regular. Regularity is not the same thing as power. If you want power, you have to move closer to the side of the table that provides capital, not just labor. That may mean owning part of your own business. It may mean owning shares in somebody else's business. It may mean buying assets that produce claims on future cash flow. But if you spend your whole life only selling hours, you remain dependent on permission. I do not like dependence. I especially do not like dependence disguised as prestige. A great many high earners walk around with expensive clothes, respectable titles, and a control problem. They make enough to look successful and too little in ownership to become free. They do not own the machine. They service it. That is not a wealth plan. That is elegant captivity. Once you understand that control matters more than applause, you begin to see why the wealthy use tools that average people have been taught to fear or misunderstand. The third trap is leverage. Now let me be precise, because this is where careless people ruin themselves. Leverage is not magic. Leverage is not masculinity. Leverage is not intelligence. Leverage is a multiplier, and multipliers do not care whether the underlying decision is wise or foolish. They simply make it larger. A weak business with leverage becomes a faster disaster. A sound asset with disciplined leverage can become a much stronger machine. This is why I do not speak about leverage in moral language. I speak about it in engineering language. What is the collateral? What is the cash flow? What is the downside? What happens under stress? Who can force a sale? How much time do I have if the world turns against me? Can the machine survive a bad year? 2 bad years, a frozen credit market, a recession, a lawsuit, a rate shock, that is adult leverage. Childish leverage starts with the upside. Adult leverage starts with the failure mode. If a person buys a house entirely with cash and it rises modestly, the return is simple. If the same asset is bought with prudent borrowed money, the equity return can be meaningfully higher because the machine is using other people's capital as fuel. Commercial real estate, private equity, and many large acquisitions are built on that principle. The rich do not merely save. They stack collateral, terms, tax treatment, and cash flow into one structure. That is why an ordinary person looking at the surface often thinks the wealthy are just more aggressive. No, usually they are more structural. They understand that a mortgage is not just debt, it is a claim structure tied to collateral. They understand that borrowing against appreciated assets can provide liquidity without triggering the same tax consequences as selling. They understand that well-designed leverage can preserve ownership while expanding optionality. But here is where fools get seduced. They hear that leverage can accelerate outcomes and decide the lesson is to borrow more. That is how men blow themselves up. The lesson is not borrow more. The lesson is understand the machine. The collateral matters, the cash flow matters, the rate matters, the covenants matter, the duration matters, and above all, the survival margin matters. I have no interest in a machine that looks brilliant in sunshine and explodes in rain. That brings me to the next confusion, which has trapped generations of hardworking people. Cash flow keeps you alive. Equity makes you free. Read that again until it bothers you. Cash flow pays this month's bills. It pays the mortgage, the groceries, the insurance premium, the school tuition, the vacation, the car note, the repairs. Cash flow is oxygen. Without it, panic enters the room, so I respect it. But oxygen is not the same thing as escape. Many people die financially in a well-ventilated room. They have enough cash flow to continue. They do not have enough equity to leave. This is why high income by itself is such a dangerous drug. It can anesthetize you. It can make a mediocre machine feel healthy because the lights are still on. You can have a splendid income and almost no ownership. You can earn 2, 3, 5 times the national average and still be one job loss, one burnout, one health event, or one industry shift away from discovering that your machine has no depth. Equity is depth. Equity is stored freedom. Equity is what remains when your labor stops. I like businesses for a simple reason. A good business can produce cash now and build equity later. In a perfect situation, the business throws off cash you can live on while its value grows underneath you. The franchise earns, the brand earns, the customer habit earns, the real estate earns, the pricing power earns, the system earns. You are no longer shoveling coal into a furnace every morning just to keep the house warm. The machine starts feeding itself. That is why some of the smartest fortunes in the world were not made by maximizing salary. They were made by owning an engine. Sometimes that engine was a company. Sometimes it was stock in outstanding public businesses. Sometimes it was real estate connected to enduring cash flows. Sometimes it was a network of operating assets that looked ordinary to outsiders and magnificent to anyone who understood what was actually being owned. Think about the simplest version of this. A business can appear to sell a product while quietly making its real fortune elsewhere. People think they are looking at hamburgers, but the machine may actually be collecting royalties and sitting on valuable real estate. They think they are watching sales. They are really watching a layered ownership structure. Average minds stop at the product. Wealthy minds inspect the machine behind the product. That difference matters. It is the difference between being impressed by revenue and being impressed by position. Now, once people hear words leverage, equity, and scale, another mistake appears. They start believing that the path to wealth is simply to pursue bigger upside. That is amateur thinking. In the real world, risk and reward are not linear. You do not have to risk $1 to make $1. In the best parts of capitalism, you risk $1 to make many dollars while trying very hard not to lose the original dollar in a way that harms the machine. That is asymmetry. I like asymmetry because it respects both ambition and survival. You can see this in venture investing, where many bets fail. A few do little, one does well. And one extraordinary winner changes the portfolio. You can see it in concentrated business ownership, when the operator understands the terrain. You can see it when a disciplined acquisition is structured, so the downside is limited, the collateral is clear, and the upside has room to compound. But asymmetry is one of those words people abuse. The internet has taught a generation to hear upside and forget ruin. They want the home run. They do not want the batting average. They want the billionaire outcome. They do not want the decade of position building, risk sizing. and emotional discipline required to stay in the game long enough to deserve it. That is why the next rule is so important. Never bet the empire for a pot of gold. I have watched people spend 15 or 20 years building a base only to destroy it with one oversized act of greed. A friend of a friend hears about a deal. The tax benefits look wonderful. The returns look rich. The promoter sounds confident. It feels like a shortcut with adult language attached to it. Then the person puts an absurd share of their net worth into one idea, one sector, one deal, one story, one promise, one private investment they do not truly understand. And when it collapses, the money does not simply disappear. Something else disappears first. Time. What vanishes is not just the principal. It is the years required to rebuild confidence, optionality, and compounding. That is what foolish sizing steals from you. A person who loses half their capital does not merely lose money. They lose years of machine building. That is why I hate oversized stupidity more than small mistakes. Small mistakes teach. Oversized mistakes amputate, protect the empire. By empire, I do not mean a castle. I mean the entire productive base of your life. Your savings, your reputation, your earning capacity, your emotional stability, your family's margin of safety, your future ability to take smart risks, that is your empire. If a single bad decision can cripple that empire, the bet is too large. This is where mature capital allocation becomes less glamorous and more valuable. The job is not to maximize theoretical return at any cost. The job is to preserve the machine while positioning it for meaningful upside. The great investors and operators are not merely return chasers. They are loss minimizers with ambition. They work constantly to reduce risk without murdering return. That is a very different mentality from the one most people are taught. Most people ask, how much can I make? I ask, what can break me? Most people ask, what is the upside? I ask, what happens in the ugly case? Most people ask, who else is in? I ask, who controls the downside? That is how empires survive. And once you understand survival, you can understand concentration and diversification without repeating slogans. Diversification is useful. It is also one of the most abused words in finance. Diversification is not a religion. It is a hedge against ignorance. If you do not understand an asset, if you do not control it, if you cannot explain how it makes money, if you do not know what would hurt it, then yes, spread your bets. That is prudence. In that case, diversification is an admission of limited knowledge. And there is no shame in that. But if you deeply understand a business, if you understand the incentives, the moat, the management, the balance sheet, the reinvestment opportunity, the failure modes, and the valuation, then concentration can make sense. That is not recklessness. That is informed conviction. The world tries to flatten these two states into one rule because one rule is easier to sell. But real life is not that neat. If you understand the risk and have some influence or control, concentration can be rational. If you understand the risk but do not control the asset, ownership may still make sense, but sizing matters more. If you control the asset but do not understand the risk, you may not need diversification first. You may need competence first. You may need an operator, a partner, better reporting, stronger incentives, or more humility. And if you neither understand the risk nor control the asset, then broad diversification is not just reasonable. It is probably your only sane option. This is why I get impatient when people argue about concentration and diversification as though one is always wise and the other always foolish. The intelligent answer depends on knowledge, control, and consequences. That three-part test will save you from many stupid arguments and at least a few expensive mistakes. Now step back and look at the whole machine. Speed starts it, time strengthens it, control directs it, leverage accelerates it, equity deepens it, asymmetry sharpens it, sizing protects it. Diversification covers your blind spots. That is a machine. Most people do not have one. They have fragments. They have income without ownership. They have opinions without control. They have diversification without understanding. They have leverage without collateral discipline. They have ambition without survival math. They have activity without design. And then they wonder why they are always tired. Of course they are tired. They are manually pushing what should have been mechanized. This is where the psychological damage shows up. A bad money machine does not just reduce returns. It changes personality. It makes you short-term. It makes you fragile. It makes you easy to pressure. It turns every bill into a threat and every market decline into an emotional event. It makes you crave speed because speed is the only relief you recognize. It pushes you toward deals that sound exciting and away from systems that look boring. It makes you confuse being busy with being strategic. It makes you consume status because you do not yet own enough control to feel secure in silence. A weak machine produces noisy people. A strong machine often produces quieter ones. When your machine is solid, you do not need every month to prove something. You do not need every conversation to announce something. You do not need every investment to be dramatic. You stop needing to win socially because you are finally winning structurally. That is one of the hidden pleasures of wealth. It lowers emotional volatility. Not because rich people are automatically wiser, they are not, but because a sound machine gives you refusal power. Refusal power is one of my favorite forms of wealth. It is the ability to say no to bad deals, bad jobs, bad partners, bad timing, bad pressure, forced sales, manipulative clients, desperate actions, and fake urgency. If your machine has no margin, you cannot refuse. And if you cannot refuse, somebody else is governing your life more than you are. The poor are not always poor because they are lazy. Often they are poor because they have no machine. The middle class often stay middle because their machine is built for maintenance, not escape. High earners often stay anxious because their machine is profitable in appearance and weak in structure. Owners, builders, disciplined investors, and great capital allocators spend their life solving that structure. That is why I tell people to stop obsessing over hacks and start asking harder questions. Can this compound who controls the outcome? What happens if it fails? Is the upside meaningful relative to the downside? Do I actually understand the risks? Those questions sound almost too plain. Good, plain questions save fortunes. Fancy language destroys them. You need a machine test. Before you put money into anything, run it through the machine. If it depends on speed but has no staying power, be careful. If it creates cash but no ownership, know what you are really buying. If it requires leverage, identify the collateral and the kill switch. If it offers upside, map the downside first. If it can injure the empire, cut the size. If you do not understand it, either diversify or walk away. If you understand it deeply, do not apologize for conviction. That is not complicated. What is hard is emotional compliance. The market does not mainly punish low IQ. It punishes impatience, vanity, insecurity, greed, and the need to feel clever. It punishes people who want to look rich before they become free. It punishes people who want concentrated upside without concentrated understanding. It punishes people who call speculation investing because the word sounds more respectable. And it punishes people who spend all of their life upgrading lifestyle instead of upgrading the machine. You can feel that punishment everywhere. You see it in the man with the luxury car and no dry powder. You see it in the family with high income and no ownership depth. You see it in the founder who sells too early, in the executive who never buys enough equity. in the saver who diversifies out of fear but never studies anything deeply enough to deserve conviction, in the amateur investor who borrows recklessly because leverage sounded sophisticated, and in the dreamer who risks the empire on one glittering deal because ordinary compounding felt too slow. I do not want that life for you. I do not want you admiring wealth from the outside while secretly remaining dependent on fragile inputs. I want you to build a machine that changes your posture, a machine that makes you less emotional, a machine that increases your time horizon, a machine that lets you buy instead of beg, a machine that lets you hold instead of churn, a machine that lets you think because it is not forcing you to panic, a machine that keeps enough oxygen in the room through cash flow and enough stored freedom in the walls through equity, a machine that uses leverage carefully instead of theatrically, a machine that takes asymmetric shots only when the downside is capped, a machine that protects the empire before trying to enlarge it, a machine that diversifies where you are blind and concentrates where you are truly competent. That machine does not arrive all at once. It begins in a much less glamorous place. It begins when you stop asking how to get rich fast and start asking what kind of structure makes fast money unnecessary. It begins when you stop worshiping income and start respecting ownership. It begins when you stop treating debt like a moral issue and start treating leverage like an engineering issue. It begins when you stop measuring wealth by lifestyle and start measuring it by control. It begins when you stop trying to win every quarter and start designing a system that can still be compounding after 10 and 20 years. That is when adulthood starts in finance. Not when you memorize ratios, not when you repeat slogans, not when you buy your first stock. Adulthood starts when you realize that every financial decision either strengthens the machine or weakens it. Every spending choice affects surplus. Every surplus decision affects ownership. Every ownership decision affects control. Every control decision affects your future negotiating power. Every negotiation affects whether you live by permission or by design. That is the chain. Break it and you stay dependent. Build it and life changes. Now here is the final test, and it is not a spreadsheet test. It is a character test. When you leave this room, you have a choice. You can go back to the old machine. You can keep chasing speed without time, income without equity, leverage without discipline, upside without survival math, and diversification without understanding. You can keep feeding a machine that makes you look productive while keeping you structurally small. Many people will do exactly that. They will call it normal. You can begin cutting every activity that creates motion but no ownership. You can begin moving a larger portion of your life toward assets, claims, equity, and controlled asymmetry. You can begin sizing bets so one mistake does not erase a decade. You can begin studying until your circle of understanding is strong enough to deserve concentration. You can begin protecting the empire even if the empire is still small. That is how real wealth begins, not with a miracle, with a machine. And the brutal truth is this: if you do not build one, someone else will. And for the rest of your life, you will spend your best hours inside theirs.